Welcome to our lesson on deductibles, copays, and coinsurance. Let's start with deductibles. A deductible is the amount a patient pays out of pocket before their insurance starts covering claims. For example, if a patient has a deductible of $2,000 and your practice bills $500 for a service, the insurance won't pay until that $2,000 deductible is met. So when the remaining deductible on a patient's insurance plan is greater than the fees charged for the services they receive, the patient would then be responsible for the entire amount due, which in this example would be $500. Most deductibles are annual, but there are exceptions. For example, TRICARE has a benefit year that renews in October, so deductibles restart then. Medicare patients have a deductible for the partial year they become eligible, and this transitions to a calendar year basis the following year. It's worth noting that Medicare does not prorate deductibles during a patient's first year of eligibility. Instead, the full annual deductible applies for the calendar year, even if the patient is only enrolled for a portion of it. For example, if a patient becomes eligible for Medicare on July 1st and the annual deductible is $233, the patient will still be responsible for the full $233 deductible for the remainder of that year. This is because Medicare deductibles are based on the calendar year, running from January 1st to December 31st, and not on when a patient's coverage begins. This can sometimes lead to confusion for patients, as many assume their deductible should be adjusted based on how many months they were covered. It's important to communicate this policy clearly and compassionately to patients to avoid misunderstandings when discussing their financial responsibilities. Some plans offer what are called rolling deductibles. Unlike most plan deductibles, which typically reset annually, a rolling deductible allows patients to combine eligible medical expenses from various claims during the so-called rolling period, often 12 months, until the deductible is met. For example, let's say a patient has a 12-month rolling period and a $1,000 rolling deductible. If they submit their first claim of $600 in June, their 12-month rolling period begins at that time. Then let's say that they submitted another claim in July, this time for $500. Between these two claims, the patient's $1,000 deductible has now been met and will remain so for 12 months after their initial claim was made in June. Although this approach can seem a bit confusing, patients often like this benefit since it provides them with more flexibility and can minimize out-of-pocket costs when they don't submit their first claims until later in the year. The manner in which deductibles are applied can vary between different providers and services. For instance, part of a deductible might apply to charges from your dermatology practice, while another part applies to a patient's primary care provider. It's crucial to verify a patient's insurance before their visit and check how much of their deductible has already been met. This helps you collect payment accurately and reduces the need for post-visit collections. Keep in mind the difference between individual and family deductibles. For example, an individual deductible might be $1,500, while a family deductible might be $4,000. Even if one family member's deductible is met, others in the family may still have outstanding amounts. Next, let's discuss copayments. A copayment, or copay, is a fixed amount the patient pays for a covered service during the visit. These typically range from $20 to $100, depending on the insurance plan. Copays are straightforward. They usually apply to office visits but not to surgical procedures. For example, let's say a patient comes in for a routine psoriasis follow-up. The copay would typically apply. But then if that same patient comes back the following week to have a biopsy performed and nothing else, then their copay may not apply. In dermatology, procedure-only visits are actually quite common and include not only biopsies, but also shave removal, surgical excisions, cryosurgery, and even PUVA or UVB treatments. So speak to your billing manager about these types of visits with respect to when a copay should be collected, particularly if the reason for the visit is only to perform one of these treatments or procedures. When copays are required, they should be collected at the time of the visit. Some practices collect copays at check-in, while others do so at checkout. Either way has its advantages, but the key is to stay consistent. We should also take a moment to dispel a common myth about copays, which is that practices have the right to defer or even to waive copays whenever requested by the patient. What some patients need to understand is that it's actually a contractual obligation to collect copays for visits which require one. Waiving or not collecting a required copay could be considered a violation of the contract with the insurance company, and in some cases can even be viewed as insurance fraud. Failing to collect copays can distort the true cost of services provided and can lead to accusations that the provider is inflating charges or offering improper incentives to patients. If an insurance company audits a provider and finds that required copays were not collected, it can lead to penalties, repayment demands, or even termination of the contract. That being said, in cases such as documented financial hardship or other special circumstances, practices may have policies in place to waive copays in a compliant manner. These policies should be well documented and applied consistently to avoid any appearance of impropriety.